Welcome back to Daily Market Insights for Monday, August 17th, 2026. Today's second quarter institutional 13F disclosures revealed a major tactical shift across Wall Street. Peter Thiel has concentrated over 70.
The macro tape opened the week under pressure from rising bond yields and heavy corporate debt issuance. The 30-year U.S. Treasury yield surged to a 19-year high of 5.308%, while the 10-year yield touched 4.70%. Fixed income markets are actively pricing in higher long-term financing costs, as corporate debt issuance to fund massive technology capital spending totals nearly $1.5 trillion year-to-date, up 36% year-over-year. This unprecedented corporate borrowing is fundamentally altering bond fund composition. According to macro fund flow data, corporate debt's share in major bond funds has climbed to 30%, while sovereign treasury holdings have dropped to 33%. With credit default swap spreads on top technology issuers widening alongside benchmark yields, the cost of capital is rising across the broader economy, forcing equity investors to demand wider margins of safety. Moving to today's standout 13F filing, Peter Thiel's macro fund disclosed an extraordinary concentration in the power and utility sector. After liquidating broad equity holdings earlier this year, Thiel re-entered the market with a portfolio where over 70% of capital is focused on electricity, independent power producers, and nuclear energy. The positions are anchored by Vistra Energy, American Electric Power, and small modular nuclear reactor developer X Energy, alongside regional grid operators DTE, First Energy, and CMS Energy. Thiel's positioning reflects a growing consensus that the biggest hurdle facing AI compute is no longer chip availability, but electricity access. With major utility interconnection queues stretching 3 to 5 years, tech hyperscalers are running into hard physical grid constraints. By aggressively buying baseline generation and regulated utility capacity, institutional capital is positioning for multi-year electricity pricing power. Demonstrating how urgent this power shortage has become, modular power producer ERock confirmed 2 landmark contracts. Anthropic signed a 470-megawatt equipment deal for on-site modular natural gas generators, while Meta contracted 366 megawatts of dedicated generation for its El Paso data center campus. These deals expanded ERock's contracted backlog to $1.7 billion, selling out its manufacturing capacity through early 2028 as tech leaders bypass traditional utility queues. In the semiconductor supply chain, SK Hynix chairman Che Tae-won cautioned that 2027 will bring one of the most severe high-bandwidth memory shortages in modern industry history. Hyperscalers are rushing to sign multi-year capacity lock agreements, with memory makers operating near total capacity utilization. While spot hardware cycles face periodic pauses, long-term memory demand from advanced AI clusters remains structurally undersupplied. Stanley Druckenmiller's Duquesne family office executed a dramatic portfolio overhaul in its Q2 13F. Druckenmiller increased his Amazon common stock position more than tenfold and doubled his Amazon call options, while building a substantial position in TSMC and initiating stakes in Google and AMD. In contrast, he completely liquidated his holdings in Broadcom, Micron, and Intel, demonstrating an aggressive rotation out of legacy chip names and into hyperscale cloud platforms. Intriguingly, Druckenmiller also initiated a sizable call option position on the Invesco S&P 500 Equal Weight ETF, ticker RSP. This suggests that despite elevated benchmark yields, one of the world's most successful macro managers is positioning for market breadth to expand beyond mega-cap tech into the broader median 493 stocks of the S&P 500. Meanwhile, Chris Hahn's TCI Fund Management made a high-profile exit, completely unwinding its multi-billion-dollar stake in Microsoft while expanding its position in Alphabet. Hahn cited concerns that third-party AI agents and plugins could disintermediate Microsoft Office's long-term enterprise pricing power, while viewing Google's search ecosystem and cloud backlog as a more resilient foundational moat. In consumer retail, Nike posted headline fourth-quarter earnings growth of 400%. But a look under the hood reveals that this was largely driven by a $986 million tariff refund following a landmark Supreme Court ruling.
Core revenue across Nike's flagship Jordan and sportswear categories continues to face modest declines as direct-to-consumer competitors like On Running and Deckers capture market share. With Nike stock pulling back below $40 per share, institutional value desks are beginning to view the risk-reward profile as increasingly asymmetric. While operational turnaround under new leadership will take several quarters to play out, current multiples reflect significant pessimism, offering patient investors a favorable entry point into a global brand powerhouse. To summarize today's market setup, the AI investment cycle is expanding rapidly from silicon to physical power infrastructure, with Peter Thiel's 13F and ERock's 836 megawatt backlog confirming grid bottlenecks as the next major investment theme. Simultaneously, super investor 13F filings highlight selective rotations into Amazon and Google over traditional chip hardware, while 30-year yields above 5.3% warrant disciplined cash flow selection. Thank you for watching, and we'll see you tomorrow.